Good morning, traders. This is Brad Matheny. Today is June 11th. This is the MENT rotational modeling system and real estate video. I'm going to highlight a couple of things taking place in the markets right now, and I want you to understand the lag. This is a great chart to start off with, this accumulation phase index, because the lag of the Federal Reserve raising interest rates is normally 15 to 18 months. So you must understand that what's taking place in the economy, the deflation that we saw, this is the SPY up here, monthly chart, the deflation that we saw over the last 12, 15 months, and we'll try to count these here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17 months now. We're 17 months from the peak, right up here. And the lag of the Federal Reserve raising interest rates is normally 12 to 15 months, roughly. And it can take a little bit longer. But we've had a number of other issues involved as well. We had the rent moratoriums. We had the foreclosure moratoriums. We had stimulus taking place after COVID. We've had student loan moratoriums. We've had a number of issues that are coming to an end over the next 5, 6, 7 months, which are really going to play a role in how the economy resettles. So understand that, we're in a sharp transitional phase in the global markets. We have not only that, but we have the presidential election cycles coming up, which, given what's gone on recently with Trump's indictment and President Biden's problems related to Ukraine and money laundering and what have you, and I'm not getting into it. I just think that it's going to be a very nasty cycle for the next 12 to 15 months for everybody. I mean, I think it's going to be beyond nasty. I think this is going to be, tabloid central. I think the crap is going to fly. I think the Fed is going to do whatever the Fed needs to do. And I think traders need to be prepared for 15 to 24 months of absolute chaos. And I mean absolute chaos in the terms of real price revaluation event. So now, before I get into my cup of coffee, let's go over the data. You know how, if you've been following me long enough, you know that I'm expecting the markets to flatten out and move into a triple flagging formation. In fact, let me come over here, drag this over, because this is my chart. Try to drag this a little bit. See if I can get it where it needs to be. All right, close enough. I'll just move it here and we'll leave it there. So this is the flagging formation. This is the NASDAQ at the top, the S&P at the bottom, and then down here we have my custom Fed funds rate data. And you can see that the Fed funds rate data has pushed higher. We're now into an upper extreme here. This means we're putting more pressure on the markets. And you can see historically how this has worked. You can see as we're putting pressure on the markets, as we're raising interest rates. This was 2017. This is weekly. Let me go to monthly. And you can see the data goes back here. 2003, 4, 5, we reached our peak up here. We started seeing it really deflate the market, and this was the collapse, the global financial crisis that took place. Then we got into near zero interest rates all the way through here, started raising a little bit back over here, ran into some chaos over here, started moving back down to zero here through COVID, and then we started to move back up over here. Now, this is the highest. You can see this is the highest rates that we've seen in more than 13 years. So, I mean, I'll draw a horizontal line across these levels right here. That's where rates are right now. And we are at the highest level that we've been in quite a while. The Fed will likely have to continue to raise rates. Maybe another half, maybe another full point before we see some real collapse in the data. But I believe real estate, commercial real estate, and the Airbnb rental real estate is really going to start to collapse the market. And I believe it's going to start to happen very quickly now. We're 17 months into this. We're seeing this short squeeze. It's going to take another 5-6 months for the student loan pause to end. I believe that ends in September. So we have all of the rest of June, July, August, and then I think it's September 1st, the student loan payment pauses. But what was really interesting, like I said, is if you take a look at the data, now this is Zillow, and they move things around. I'm looking around here in California, so I've pretty much covered everything from San Diego all the way up into, and I'll go up here to San Luis Obispo, Atascadero, Pismo Beach. If any of you know anything about California, this is a fairly, Atascadero, Paso Robles, this is a fairly affluent, beachy community up here. Santa Maria, Pismo Beach, everything. Then you move into Santa Barbara, very affluent area. This is northern Ventura County, where a lot of movie stars, Michael Jackson lived up in here, and hundreds of others do. Then you have, this is the Mojave Desert, Edwards Air Force Base. This is really, Barstow, Yermo. This is an area, Ridgecrest, where a lot of military out here, a lot of military stuff out here. Victorville, this is an area that has seen some growth. I mean, you can see here, we're getting foreclosed house here in Victorville of $700,000. Crazy. I mean, it's just really crazy. These are just foreclosures. Okay, so what I've done here is I've highlighted just foreclosed and foreclosures. Okay, if I go to pre-foreclosures, try to move off of this. So these are foreclosures. We have a total of 40 foreclosures in pretty much all of Southern California. Okay, if I go to pre-foreclosures, basically homes that have already entered into the foreclosure process, they're not completed yet, boom, we go up to 1,750 units. They're starting to pop up everywhere. Okay, and you can see massive amounts down here in San Diego, not so much over here in Irvine and Huntington Beach and Long Beach and this whole area. This is an older area of Orange County. So basically you have San Diego County from right about here, starts downward, right below Temecula here, starts downward. This is all San Diego County. Out here is all Riverside County, and out here is all San Bernardino County. San Bernardino County is huge. Then you move up into Kern County, up here, up into this area, Bakersfield and such is Kern County. And then you move into LA County is the central Los Angeles area, right over in this area. And then you move up into Ventura County, up in this Oxnard area. You move into Ventura County going north. But again, more than literally 1,700 pre-foreclosures, and this is early. And some of these pre-foreclosures are massive. I mean, you take a look here at some of the estimated pricing and where they're at. So here's $1 million in Palmdale. Palmdale's in the desert. Nuevo's in the desert. 800,000, 200,000 for a 5-bedroom, 3-bath in Moreno Valley pre-foreclosure. Here's a Victorville, $700,000 home in Victorville. Remember, $700,000 is a lot of money for a house out in the middle of the desert. You're looking around here at some of these houses, and again, some of them were massive. You know, here's Burbank. This is a $3.9 million pre-foreclosure in Burbank. This is a massive 6-bedroom, 7-bath home. Most of these are probably on adjustable rate mortgages. Here's 1.1 million in West Covina, 530,000, 200,000. I mean, it's just scary to see some of the homes. Tehachapi, okay, Tehachapi's up in the mountains, up in the lower Sierras, let's call them. Nice area, very reclusive, very rural. Altadena, this is a area that used to be a big dairy farming area. Woodland Hills, I mean, Woodland Hills is, if you don't know anything about Woodland Hills is North LA County, very, very affluent area. You're going to start to see some of those coming in. Menifee down by San Diego, very affluent South Riverside County. Here's a home in Los Angeles, Waverly, pre-foreclosure, $3 million. Just massive amounts, 2.56 million in Woodland Hills. I mean, these are basically these are the affluent. Okay, these are the affluent homes in California that are now starting to become pre-foreclosures. Look at this one. Oh my gosh, Los Angeles. I mean, this is I don't know what to say about this. This is like a movie star's home. It's decked out. It's completely done up. I don't know what to say about this. I mean, look at this is just incredible. Some of these homes, somebody put some effort and some money into this, whether it's a rental that's now being foreclosed on or what, I don't know, but it is a pre-foreclosure, 5-bedroom, 6-bath. It built in 1965. It looks like I said, it looks like it's not just the little guys anymore. It looks like the bigger guys are going to run into trouble. So Whitewater is out near Palm Springs, little dinky little place. And again, we have these out in California. You go out here into the desert area, you're going to find quite a few of them. But the point I'm trying to make is we're starting to see some pricing values that are going to really start to drop. Now, this Apple Valley area, it sounds really nice, but it's way out in the middle of the desert. And these types of homes, when they're in great shape here, probably about 160, 180,000 would be a decent price for a house like this. 390 is completely overvalued. This here in Temecula is a wine country, and this has probably got a lot of land. 1.5 acres. It looks like it's kind of a barn gamble style house. Temecula's very nice area, wine country. It's out near Anza Borrego, which is a desert area. It's pretty much the border of like a coastal mountain range in the desert. So when you start looking around here at what's coming in for pre-foreclosures, you can see huge numbers of various types of homes. Look at this one, Apple Valley. So now 1.85 million. Apple Valley, remember, is desert area. Okay, it's high desert area. Somebody's got 1 acre of land. They've done this whole place up. It looks like they built this place up. Somebody moved in here, was absolutely enjoying themselves, whatever it is. And now you've got a scenario where this is moved into foreclosure. It is in pre-foreclosure area. This is kind of a rich McMansion area. And again, it's not the best area overall, but still $500 a square foot. And if you come down here and you look at the pricing structure, look at these areas. So this was basically 2015-16 was selling for 400 grand. Now it's $1.8 million. So we're looking at a massive decline, probably back down into this area back over here, $500,000 for a place like this. And it's just going to be a matter of time before it happens, especially with all these foreclosures kicking in. And that's something we can look at. So okay, Atascadero is up north. It's up in the northern country. Nice area. But let's take a look at the pricing structure again. So we go back to 2015-16. The pricing area is roughly $450,000. Back in this area, this is where it was selling. It's now at about $800,000. This is going to take basically a 50% decline in foreclosure to get back down to reasonable levels, maybe a bit lower. Let's take a look at something else. Okay, here's Los Angeles, Mulholland Drive. Okay, any of you guys know Mulholland Drive? Mulholland Drive is up in the mountains, very nice area, older area. This is where a lot of people come out to the coastal mountain range and hang out. Hollywood Estate home. So again, look at pricing data. 2015-16, this was selling for about 2 million, 1.9. This is 2014, 1.6 million. Now it's up to 3.5 million. So in order to get down to that 1.5, 1.6 million area, it's got to drop about $2 million on a price level like this. That's a 65% decline for a home that potentially is moving into foreclosure. Let's see, Agua Dulce is desert area, nice area still. I mean, most of California is desert. You have to be aware of it. Paso Robles is a nice area still up north. Here's Templeton, which is up near San Luis Obispo, Tascadero area. Let's come down here, take a look at what's next, find something that looks decent, take a look at pricing value. So this gives you an idea how overvalued things are in the area that's out here and what's coming. Remember, we started off with just 40 foreclosed homes in the area. Now we're looking at 1,700. Here's Oceanside. Okay, Oceanside is very close. It's in technically San Diego County. It's northern San Diego County. It's seen a good bump. It's a quarter-acre lot, traditional home, $400 per square foot, and you're going to see pricing values here. 2017-18, this house was $600,000. Now it's $900,000. This is going to basically take a 30 to 40% price decline as these foreclosures, in my opinion, start to come out. And like I said, once the 1, 2, 3 punch of the higher rates, the ending of the moratoriums of the foreclosures. Here's another Oceanside, find something else. So this is kind of a good way. So here's Carlsbad. You can see it's very close to the ocean. 2-bedroom, 2-bath, probably apartment. Where it's got $1,200 per square foot. Wow. 2 parking spaces, a townhouse, very close to the beach. You can see here, again, price functions. Back in 2017-18, this was $700,000. Now it's $1.6 million. This basically is going to drop, 55, 60% if these moratoriums kick in. And you can see the rally. So if you basically take a trend line, the way I do it, you take a horizontal trend line across these areas, this is going to put us back down here into this probably 750 range. Maybe, and that's again a drop of 60% of the value from this area, and that's again simply because of the stimulus. People just went crazy. I don't know how to say it. Escondido. This looks like a townhouse. So anyway, we come back over here, and this is the one I thought was funny. So let me go to get rid of pre-foreclosures. And let me come back down here to the one that I thought was kind of interesting. Where is it? There was one in LA that, am I on the wrong page? Where am I? Here it is. 180 some days on Zillow. Look at this place. Foothill in La Cañada, Flint Ridge. Now, this is an area that had fires and muds and what have you, but look at this place, $4.9 million. It's been foreclosed. It looks like someone's custom home. Looks like it's been staged and set up for sale. It's got its own studio. There's LA. That's what LA looks like from the distance. La Cañada, Flint Ridge gives you the ability to look all right over Pasadena and down into LA at the coastal area. And again, you can see this is a massive place. 4.6 million on 3.5 acres, but look at the pricing structure, right? Here we have it right over here. It's just basically been out of whack with the rest of the market. So this is a custom home, been completely out of whack with the market. It last sold in 2022 for 4.8 million. It's on the market for 4.9 million. You can see here 7, 8. So there's been some higher numbers. But this is really, movie star style home. So this is, $79,000 a year in property tax assessment. But if something like this is getting foreclosed on, really, what does that tell you? Really, honestly, what does that tell you? So we have, and these are just the foreclosures right now. So Victorville's getting hit really hard. The high desert's getting hit very hard. This is probably because, like I said, people got into adjustable rate mortgages, and now they're getting slammed. A couple of very interesting places here, 4-bedroom, 3-bath. This is Anaheim near Disneyland. This looks like a collective. This looks like single family home built in 62. So let's see the pricing structure. Yeah, see 1.5 million, whereas back in the day was only 800, 600,000. So again, this is a 50% decline going, in my opinion. And we're just starting to see these things kick in. So that's why you need to kind of watch these pre-foreclosures and auctions, because once you get in to start looking at where these things are, we're looking at close to 2,000 homes, and this is very early, moving into a foreclosure, a pre-foreclosure area. And I'll bet you by the end of the year, we're probably looking at 6,000 or 7,000 homes out here into foreclosures. With this is the flood of inventory that's coming, and it's going to start to affect the markets very strongly over the next 6 to 12 months. Okay, I'm not trying to waste too much of your time, but I want you to go through it. Now go to Zillow and look up your area. So understand that, Chicago, you can do this just as well. I'll move outside of Chicago, zoom out a little bit. So if we come out here, get rid of auctions and pre-foreclosures, Chicago has 115 foreclosures taking place right now. This is the greater Chicago area. We come into auctions and pre-foreclosures, you have 421. So a little bit of about a 350% increase. And pay attention to where these foreclosures are actually taking place. So let's go down to Phoenix, just for the heck of it. Phoenix, Arizona. Okay, go outside of Phoenix. So here are the broader foreclosures in Phoenix, 250. Get rid of auctions and pre-foreclosures. You only have two units in foreclosure right now. Whereas if I come in and I pull up auctions and pre-foreclosures, which show you what's coming, pre-foreclosures or what's in the early pre-foreclosure process, you have 250. So that's essentially like a 2,000+% increase in homes that are coming in the market in foreclosure. And like I said, I think as the market starts to tank, I think these Airbnbs and these short-term rentals and consumers are really going to start to pull back. I think you could see a flood of homes piling into this as we move forward. So have some fun with this if you want to. Let's take a look at the data. So the markets are really trying to flatten out here. I think we're going to see some real chaos going forward with the presidential election cycle and the economy. Consumer is starting to bounce a little bit. I think this is still going to flatten out. I don't see any real engagement. I think we're going to move into a very chaotic and nasty presidential election cycle, which is going to keep everything fairly muted. Large cap index is stalling out. I mentioned to you a couple weeks ago that this was a pretty big move, big reflation, a big kind of a short squeeze, capital rushing into large caps, trying to avoid risk and find safety. I think it's going to stall out and weaken a bit. Innovation index is moving higher. I think we might have 4 or 5 weeks of real gain, maybe up into this 120, 140 area, kind of up in this area where I'm circling. Let's call it 110 to 135, right up near this peak area here, or at least this peak area here. That means we have 80, do the math real quick, 8. So we got about 15, 20% to go to get up into this area. You have some real opportunity for some gains here, 2-3 weeks in the innovation index. The custom fear index is moving downward, 7.67. The S&P has reached a peak up near 430. We could still reach 433, 434, 435 here on kind of a blow off top. But I believe if you look here at this index down here, the sentiment index, I believe we've already reached the top. I think this is basically, it could shuffle around over here for a week or two, up in this 403, 405, 406 area, maybe get up to 434, 435 up here, but I think this is the spike peak already. So we'll see how it settles. It's just that we could still waffle around over here before we actually see a rollover top. U.S. valuations index is showing no real growth yet, flattened out. like I said, we could get a breakdown. We could literally get a breakdown if the chaos happens, see it move downward down into this area. So we could see it retest this area back over here if we get some massive chaos. Leading index is stalling out. That means we're not seeing any real growth here. You can see we're getting a bit of divergence here across trending. Be very, very cautious over the next 3, 4, 5 weeks. We could see a lot of volatility and a lot of chaos in the markets. FANG's index have come up and really overextended. This is extremely overbought. So be prepared for a topping formation and watch money potentially roll out of FANGs. If this starts to really collapse, watch for capital to roll out of the FANGs in the technology sector as this collapses back down into this 160, 180 area, trying to find support, maybe deeper. This is completely overbought, overvalued right now. This is a big speculative bubble. Okay, the MENT rotational modeling system is weekly bullish, daily bullish, combined bullish 100%. We're up 4.49% on our current position, which is a combined system. We have no changes in the sectors that we follow. Everything has stayed the same as last week. Remember, last week I lowered the stocks allocation from 35% to 20%. The purpose of that is to remind you that we need to be prepared for this chaos that I'm telling you is coming. You need to start pulling profits. You need to start actively protecting your capital right now. I can't urge you enough to take the steps now to pull your capital, your profits away from the risks that I see setting up in the market over the next 3 or 4 months. I've highlighted this for months and months and months. If you're not following my research or heeding my advice, you may end up seeing a 15 or 20% decline in your assets. If you move 50 or 60% of your capital away from risks right now, move them into safer sectors, cash and metals and potentially even bonds, and away from stock risks, you're going to be more immune to the risk. So hypothetically, a 15% decline on 20% of your capital is much better than a 15 or 20% decline on 50 or 60% of your capital. You can withstand the drawdown more effectively pulling profits right now, which is why we're shifting away from extreme allocation right now, not trying to be a fear monger or anything of that nature, but my job is to keep you aware of these setups before they happen, not after they happen. Next, the MENT rotational modeling system is holding its own. I updated these through the end of May. We're still doing pretty good. We're not having a banner year right now, but we're holding up pretty well. We had moved up over the last basically 60 days. We had moved up about $100,000 in the account here, while the S&P had moved up about 45,000. So we're doing okay. We're holding up on our own. And I had this new chart here, which shows the monthly performance. So if you look in here, the MENT rotation, kind of hard to see, but the little orange line over here is the MENT rotational modeling performance. Sorry, blue line, this is June. This was May. So you see here in May, October 22, oh, this is quarterly, excuse me. This is monthly. So here you can see how the monthly performance, the MRM is blue and the S&P is orange. We'd been holding up on our own. Okay, we had a couple of big moves here, and the SPY performed, and then the MRM was fairly flat. Now we're kind of flattening out. We're getting ready for some bigger moves. When we flatten out like this, basically we're moving into a neutral type of a stance. So we're 100% long right now, and we're looking for the markets to move higher. We could move into a broader upward trend, but like I said, there's a lot of chaos coming. So be prepared for chaos. And then here's the comparison, MENT rotational modeling system to SPY. And what I've done here is that January 1st, 2019, I basically took the data, the comparison data of the SPY and the MRM, and I tried to show you how the MRM performed compared to the SPY going forward. So this is basically mark to market, day by day, going forward through COVID, how the MENT rotational modeling system performed compared to the SPY going forward. You can see here in 2022, we had some drawdowns. So this is a, 14% drawdown, another one here. And again, maybe a little bigger the way I've drawn it, maybe 22% here, but this is not long term. But this is the difference between the MENT rotational modeling performance versus the SPY performance. And you can see we've rolled into this little upward trend right now. So we're kind of looking at maybe catching another big trend over the next 12 or 15 months going forward. So the purpose of the MENT rotational modeling system is to help you manage and protect your investment retirement income. Okay, the real estate market, very collapsing numbers. What I'm seeing here is that basically, as I mentioned to you a couple weeks ago, I think homes are being pulled off the market, out of inventory, out of active listing as they move into a pre-foreclosure or early foreclosure process. And it looks like it's coming true on the Zillow listing of pre-foreclosures. There's massive amounts of pre-foreclosures taking place. I mean, literally, possibly hundreds of thousands of homes are going to move into foreclosure over the next 6 to 12 months, especially if the economy continues to contract and the presidential election cycle turns into a nasty slugfest. What we're looking at right now, though, is dynamic price and trend modeling is weakening. So understand that real price trending has moved from a positive 40% down here to a negative 15 or so percent. Real adaptive price modeling and trending has moved downward as well. So understand that we are moving into a very strong downward trending. Demand is dropping and real estate prices are dropping. So a real price factor is minus 25. That would be this one. And model market demand is dropping. It is a minus 12.45. That's this one. This is telling us that demand and price are dropping. This is when we start to see big price declines kicking in. Okay, that's what happens next. Large price decline. So we would expect this price decline number, which is price reduced count here, to start increasing back to the upside. Real price trends moving downward, price reduction activity flatlining, really kind of bottoming. If you look here, this is a deep low here. It's rolling back up. Real estate active listings change. It's bottomed out at minus 20, rolling back up. New listing count metrics has flattened out. Probably going to start kicking back in once these foreclosures kick in. Again, real estate heat rank is completely flatlined. Real estate tightness rank is a little bit positive, meaning it's gotten tighter in the market. No inventory. Is it going to tighten up the market? Real estate inventory strength is weakening and a spike in seller desperation. Seller desperation is now 316%, folks. That's telling you that sellers are really freaking out. If they're trying to get out right now, they're starting to become very desperate to get out before the market actually falls apart. We have lastly here the volatility index, and I've highlighted this last week about how this upper level, about 15.5 or so, was extreme topping, and look at us now, 16.65. So again, the only advice I have for you, and again, from my heart, heed my warning. This is very, very toppy. You need to be very prepared for some type of chaotic price volatility over the next 3 or 4 weeks. This is extremely toppy. This is the most I've ever seen the markets in this area. Again, we've never seen a end of week price trend close up above really the 16.5 level. This is the highest topping type formation I've ever seen in the market. And that tells me that we are very overbought, overextended on a short squeeze, and I very much believe that we are going to enter into an extremely volatile period. Those of you that are taking advantage of this, maybe trying to get into SPY put trades or VIX call trades, call options, I mean, you may be right. I'm not going to advise you But when this reverts back to the downside, it's going to come back down into this 10, 11, 12 area, maybe a bit lower. It's going to basically be a 7 to 10% price correction. It may be a very big top. It aligns very well with my analysis. Remember, back over here, my analysis is that we are going to move into, we've reached this peak up here. Look at where price is. Let me try to get price on top. Visual order, bring the front. Visual order, bring the front. Okay, so look at where price is right here on the SPY right here and on the NASDAQ right here. It's very, very close to that upper flag channel, this flag channel right here and this flag channel right here. If my analysis is correct, remember I started highlighting this about a month ago. If my analysis is correct, we've reached our peak. We're going to roll downward back over into this area, try to find support back in this area, roll into another sideways flag near the end of this year, maybe get some sort of a bounce, and then roll into a broader flag, which is going to carry out all the way towards the end of the election cycle. Apologize, got a little phlegm in my throat. So again, this is where we're at. We've seen this massive short squeeze. We've seen this big bump to the upside, and I'm urging you, pay attention. Get yourself into a protected, safe stance in the markets. We do not want to be overly aggressive right now. The smartest thing that you can do, in my opinion, is move 80% of your risk capital away from the market, move your stops effectively for the rest of your positions, maybe hedge a little bit more effectively. And again, I'm not telling you what to do, but we're likely going to see some volatility. We're likely going to see the VIX spike. We're likely going to see some rotation in metals. We could see oil move downward on a economic contraction. We're going to move into some real chaos, I think, over the next 12 months with regard to everything going on. And you need to basically be prepared. This is a very solid level. If you could pull 80, 90% of your capital away from risks at this level and ride out the next 6 to 12 months safely, preparing for what's coming next, to me, that is an excellent solution. If you're still looking for some real opportunity, maybe get into some inverse ETFs like the QQQ or the SPY or technology. And look for that next 7 to 10% downward move. Try to grab your 10, 15, 20% on that trade over the next 2 or 3 months before we find a bottom back over here. But remember, this is, in my opinion, we're as toppy as it gets. Okay, this is pretty much, we've hit the ceiling. I don't see we go much further. I see we roll downward over the next 2 or 3 weeks into a broad decline, and that's what's coming next. Houses will probably start to flood the market over the next 5 to 6 months as foreclosures take place, and be prepared. That's going to send a shockwave across the markets and across the Fed. So that means that we could be looking at the Fed moving into save the world again by 2024 or so. We'll see how it plays out. Okay, guys, that's it for now.